Welcome to this week's Q&A. We've got a great question from one of our viewers who's just moved back from Singapore to Australia. So they've repatriated from their prior country of residence, being Singapore, and they're now moving back into the Australian tax system. So the question is, how can I legitimately minimise my income tax upon returning to Australia, as it's going to be much higher than I'm currently paying in Singapore? And once we utilise the normal measures, I suppose, of reducing tax through allowable deductions, one of the things that people can use, which is really quite pertinent to Australian expats working and living overseas, is the catch-up superannuation concessional contributions that they could potentially avail themselves of. Because what we generally find is that if people have been living and working overseas somewhere for a number of years, they haven't been making contributions to their Australian personal superannuation fund, and neither has their employer, clearly. So it quite often happens that these people have typically a small-ish superannuation balance in their account, so maybe $150,000 to $300,000, and that puts them into a perfect position to potentially use this mechanism to really have an important impact on reducing their income tax, especially perhaps in the first year that they repatriate to Australia. So how this operates, this provision was brought into legislation and effective from the 1st of July 2018. So if you qualify, in other words, if you have a superannuation balance that's less than $500,000 as at the 30th of June in the prior financial year, and you haven't made use of your full concessional contribution caps, or in many instances, like we've seen with our overseas clients, they haven't used any of those, so there've been no contributions made. And what happens, for example, is, let's say you've made no contributions for the last 5, 6, 7, 8 years, you move back into Australia, your salary is high, so above $280,000, and you're looking to reduce the impact of income tax on your take-home pay. What you can do is, at this current point in time, you could actually use the catch-up provisions. Let's say your superannuation balance is $200,000. You can use those catch-up provisions to make a contribution now to encapsulate the last 5 financial years. So 3 years at $25,000 per annum and 2 years at $27,500 per annum would mean you could actually contribute $130,000 and only pay contributions tax of 15%, as opposed to paying the top marginal rate, which would be 47% of your income earned in Australia. So quite a powerful way to manage your tax affairs if you have sufficient cash flow or sufficient cash assets on hand, and also help catch up on your retirement savings so that you don't miss out on all those years that you've potentially been working as an expat and not making those virtually compulsory, say, superannuation guarantee contributions from your employer, or personal deductible contributions into your super fund. So this is something that's really important, and this current financial year ending 30 June 2023 is the last year you can use these 2019 deductions for. So something worth bearing in mind, and something we're constantly speaking to our clients too, who are Aussie expats around the world, and many of them repatriate at different times of every year. So it's something that's really useful. And look, if you found this of interest, then please subscribe to our YouTube channel and click like. And if it may actually assist your own certain personal set of circumstances, please don't hesitate to contact us, email us or call us, and we can get somebody to get in touch with you, see if we can't help you with your own personal situation. I'm Andrew Unterweger, and I'll see you at the next Q&A.